Welcome to Berkeley, Middle East. Today we are here to discuss the course that is specially designed for non-accountants to understand the accounting terminologies, accounting procedures, and after doing they can do effective working in the accounting department. Broadly, we are going to discuss the basic infrastructure of double entry. Then what are the accounting documents that we used in the accounts and finance departments, and then we will extend our discussion about certain kind of procedures that generally we adopt in the accounts and finance departments. We will start our discussion from accounting equations and balance sheet. The first important thing is to understand the ABCD of the accountings. Generally we have A that stands for assets, then we have C that stands for capital, and then we have L that is for liability, and E and R is for expense and revenues. So 5 major terms we have to discuss in accounting. There is no sixth term that is beyond these 5 terms. We will use expense and income, we will make profit and loss account. We will take assets, liabilities, capital, and we will make a balance sheet. Generally, assets is equal to liabilities plus capital. What are the assets? What are the liabilities? What are the capital, expense and income? This is shortly we will discuss with you. Now, we will learn what is double entry system. Accounting works on a system called double entry. It has dual effects for the same transaction. One is called debit, one is called credit. Debit has certain rules. When to debit? There is no definition of debit and credit. In fact, you have to learn the use of debit and credit. For example, if you bought a mobile, so mobile has to be debited or credited. Or mobile is what? Like assets, liability, capital, expense or income. This you have to see. For a layman, it may be an expense. For a company, it may be an asset that they will use it for its useful life. So this we will discuss here now, how to understand the assets, liabilities, capital and its usage. Then stocks are very important stuff in the companies, how to record the stock, what is a purchase, is it a debit, it is a credit, how to record in the books. Then effects of profit and loss on the loss, on capital, the double entry system for expense and revenues, balance of accounts and trial balance. Generally, if you work in an accounts department, surely they must be using some software. This software can be a small software, it can be a ERP based software. But the general mechanism of the entry or the document set will remain almost similar, equally same. For example, if you want to enter the purchase, or you want to enter the sales, or you want to enter some expense, or you want to enter some cash, or you receive some cash, you want to record in the accounts. So the general mechanism will remain the same. First, we will record in a window called journal, which is showing you a debit or credit. In certain circumstances, for the user-friendly software, when there is no debit credit concepts, you will get a PO in front of you. You have to fill the information. On back end, the system is itself managing its debit and credit. Then same way, your focus should remain on the what is journal, then the information split into a ledger, we close off, balance off, and then we make a list of accounts that is called trial balance. Once we get the trial balance, we have to make a trading profit and loss account and the balance sheet. Trading profit and loss, out of the trial balance, we will take the expense, we will take the income, we will make the profit income statement. And then from asset, liabilities and capital, we will be developing a balance sheet, which is now named as statement of financial position. Then there are certain expenses about which we have to learn, is it a capital expenditure or it's a revenue expenditure. For example, if we buy a car, this is an expense, this is we show. But this expense is a revenue expense, means day-to-day expense, or it is a capital expense which is related to the assets, the valuables. Surely we will classify this kind of purchase as capital expenditure. What is that? What is capital expenditure? This is we are going to discuss later in this portion. Bad debts, we will discuss what is bad debts. When we make sales on credit, some people announce themselves that they are not able to give the money, so they are considered as bad debts. How to record the bad debts in the systems, this is we have to learn. Concepts of accruals and prudence. Accrual, actually accounting has two systems. One is the cash based accounting, means you receive cash, you write in your books. You pay cash, you write in your books. This is cash based accounting. Along with that, we have accrual based accounting. What is that? We are going to discuss. Then concept of going concern and consistency. Generally when we develop the accounts, we have to keep in mind that this company should not close before 12 months generally as a trend. So this is the concept called going concern. Then we have depreciation of the fixed asset. What is depreciation? This is the decrease in the value of fixed asset. This is we have to learn. Then we said there are certain accounting policies which are built in how the accounts will be made. It is the historical cost, the prudence principle, then consistency, matching. Double entry records for depreciation, we will understand the valuation of stock. Then monthly we have to make the bank reconciliation in accounts department. What is that? You take the bank statement that received from bank. Then you have a cash book having a bank account. You see your transaction, this is here, this is here, this is here, this is not here, this is here, something you find out, and you make a bank reconciliation. You reconcile, rematch bank balance with your and come up with the agreed balances. This is the spirit of making bank reconciliation statement. Generally in accounts department we make it on monthly basis. Then we have control accounts for mainly for receivables and payables, customer and suppliers. But for any purpose we can make a control account. The purpose is to put all related information into one account and get the picture of it, that where it stands. Then errors not affecting the trial balance. Generally accountants do a lot of mistakes when they do the work. Sometimes they forget to put the entry in the system. There is no entry, and in fact it's an error of omission, means he forgets to enter. Sometimes you need to enter the 49 as a debit or credit, you enter 94. You reverse the arrangement of the digit unconsciously. So it is error of transposition. And there are a lot of errors which generally we make, and it does not affect the system. How? Suppose if you forget to enter something, there is no debit, there is no credit. So how the system debit total is equal to the credit total? Because you never put debit, you never put credit, so how system will know that there is an error? So there are some errors, which is error not affecting the trial balance. Opposite to this, there are errors which affect the trial balance. You enter debit as 100, credit as 120. So the difference is 20. It will show in the books. We have to correct it somehow. Then there are suspense accounts in error, which is very common. Suspense account is an account which we are not sure about. We are looking to the accounts, trial balance total is not agreed. Now it's a company, a lot of transactions are there. We are not sure that what is the issue. So, but we have to close the account and we at the year end, and it's less time with us to see what is the difference. So we'll put this account called suspense account. Means we are in suspense with this balance, we'll put it into it. And this is how our trial balance will match, and we can prepare the financial statements. Later with the investigation we can find out what was the mistake, so we can remove this account with the effects by doing the actual effects. We will discuss very important accounting ratios. Ratios are when you take assets, liabilities, capital, expense and income, you multiply and divide, and you take certain ways to see. You see the short-term ability to pay the company, you see the long-term ability to pay the company, then you see that how much assets they have, how efficient they are in the business. This is the ratios generally we have to analyze in terms of your profitability, in terms of your operationability. Then single entries, some system like small shops, they work on single entry. They don't put this double entry, debit and credit. They only write, okay, this is a man, this is a list of receivables, number one, this is XYZ, and we have to take 10,000. This is one effect. So how to convert this, what is that one effect, and how to convert into a double entry, what would be the possible consequences, we will discuss today. Then we will discuss the receipt and payment accounts for NGOs, non-profit organizations, and in the last we will go in the practical working environment, where we assume that we will be working in the finance department or accounts department, and then we will discuss what are the necessary documents involved in the general ledger, accounts payable. We will learn that accounts payable should have a PO, purchase order, then there should be the signatures of the purchasing authority who approved that one. Then it will, the quotations will be called from the market, then specific delivery will be received, delivery note will be received, and then with the items, so we'll put a GRN, what is GRN, good receipt note, how it looks like, and then how to complete the purchase cycle. Then what is account receivable, means who will make the quotation, how it look like, what is the signatures required on that. This sale order confirmation, who will develop, then the delivery will be made with a delivery note, and then we will issue the sale invoice. What documents are required in this concern to complete the whole sale cycle, we will discuss as in today's lecture. Then we have to discuss how to manage the cash in the companies, what is the procurement procedure, how companies go for a supply chain management, how to keep fixed asset in a line, and what are the HR roles, human resources, how to record the payrolls, and what are the accounting solutions generally we can have in the systems. This course is specifically designed for those candidates who want to pursue their career in the accountancy field, and they are more into non-accounting background,